Welcome to Kopi Time, podcast series on markets and economies from DVS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 162nd episode. Today, we will have the Chief Economist of AMRO on our podcast. What is AMRO? It is the ASEAN Plus 3 Macroeconomic Research Office. It was established back in 2011 by the ASEAN Plus 3 finance ministers. AMRO's aim is to contribute to macro and financial resilience and stability in the region. It comprises of 10 member states, all the ASEAN countries, plus China, Hong Kong, Japan, and South Korea. This is the second time we've had the pleasure of hearing from AMRO's chief economist, but our guest is not a return guest. Dong He took over this position just a few months ago. He has had a 3-decade-plus career bookended with long stints in the world of multilateral surveillance, both at the World Bank and the IMF. In between, there was also a decade at HKMA, Hong Kong Monetary Authority. I've known Dong primarily as a financial sector expert, having worked with him in the IMF many years ago. Now, his hat is even bigger, overseeing AMRO's country and regional surveillance, as well as research activities related to ASEAN Plus 3 economies. Dong He, welcome to Kopi Time.
Hi, Taimur. Very good to be here.
Great to have you, and welcome to Singapore, Dong. This is the first time you're living in this country.
Indeed. I visited here before, but never lived here, so it's been very interesting to be here.
Very, very pleased to have you in our neck of the woods. Dong, I will just cut right into this discussion. We have a lot to cover. How do you see the impact of U.S. tariffs and policy uncertainty on trade and investment flows in the region?
Certainly, it was a very big shock for the economies in this region when the U.S. administration started introducing tariffs and all sorts of uncertainties. But the outturn so far in the first half of the year was better than expected. I think a number of things were going on. If we step back a little bit, thinking about trade theory, how a tariff shock would affect the economies. So for the affected countries, it's primarily a demand shock. So there is the direct part and also the indirect part. The direct part, of course, if the tariffs lead to higher prices, that might reduce the demand in terms of the quantities you can sell your goods. And that would be the impact of the direct impact. But there's a second round in the sense that if the imposing countries' economy is hit by the tariff itself, that would lead to a reduction in the demand for other goods and services more broadly. So when we think about the ASEAN economies, let's say, these are very small open economies. So the shock in terms of reduced demand for their goods and services is quite evident. So that if you just do all sorts of simulations, you can see the impact is quite big. But I think the impact on the U.S. economy itself is quite interesting because actually the theory says the net impact on the imposing country is not that obvious. The empirical literature says that on output, usually it's negative, but on inflation, it depends on many things. So far, we know that in the US, inflation has shown some inertia, but it has not shot up as originally sort of feared. So the number of things going on. This is on the negative side. On the positive side, of course, as you know, this is AI sort of a boom time. So what we have seen is that the Asia-Pacific economies have been very much, of course, in the center of AI-related semiconductors and the electronics goods. And their exports actually has been very strong. It's in the first half of the year, the global chips market exports have been growing like almost 20%. So you have the negative side of the trade associated tariffs and uncertainties. But on the positive side, you have AI-led export growth. So on net, the impact has not been that great.
Not yet.
Not yet.
So Dong, let's stay on the trade side. I want to talk to you about the regional investment cycle around AI a little later. But staying on the trade side a little longer, the key issue to me is the uncertainty that the deal that the U.S. offers a specific country, anywhere in the world, not just Asia, may not be the deal that stays a month from now, 2 months from now. There's degree of brinkmanship, some degree of bargaining back and forth. So the tariffs are used as a bargaining chip to some extent. With this volatility of outcome with respect to tariff, which typically sticks and stays, it's negotiated or imposed and then stays there for a long time. And now it goes up and down. Through the course of this year, we've seen low tariffs and high tariffs and then medium tariffs. So what is your sense of the investment environment in the region faced with these sort of volatility on tariff? How are countries and corporations dealing with the uncertainty?
Very good question. Actually, when we think about the impact of tariffs and uncertainties, we need to differentiate between short-term impact and the longer-term or medium-term impact. So the medium-term impact is really to create incentives for firms to deal with such uncertainties and maybe set up or reorient their production networks that will become more resilient in the future, because you cannot assume this sort of uncertainty will go away.
Right.
So what we have seen is that there are actually commitments or applications for FDI have really been growing tremendously in the region, in the Southeast Asian, in ASEAN economies. Many have seen 20%, 30%, even higher than that sort of growth in the first half of the year. And if these commitments or these applications become realized, then one upside to our outlook is going to be higher investment growth in these economies. So behind this, of course, is that the firms have to rethink the production networks in this sort of age of uncertainty and fragmentation, how to become more resilient. We're going to see a lot more intra-regional trade, and that also is a result of intra-regional investments, FDI. Not only intra-regional, actually FDI even from the US and from Europe have been going up very strongly, these applications in the region.
No, I fully concur. Malaysia, even 5-6 years ago, if we looked at the balance of payments account, FDI in tech-related areas was very, very small. Sometimes it'll be zero in a quarter. Now we're talking about billions, tens of billions of dollars coming to just in Malaysia. We see similar stories in Singapore, we see in Vietnam. But that takes me to this question that I'm not asking you to say who are the winners or losers, because I think it's way too premature, and I think winners or losers are not the right way of looking at it. But just in terms of countries that are managing better than others or receiving more investment than others, where do you see most dynamism in the region, and where do you see somewhat lackluster dynamic?
I think creating a very enabling environment is certainly a very key task for the governments. Spending on infrastructure, make infrastructure networks much more efficient, and make your policy regimes predictable. And I think these are very important factors. Of course, these markets tend to be small, so countries have to think where in the broader production networks they want to be in, right? There are cannot create one supply chain.
Right.
In your own economy, you have to work with others in the region. So collectively, these countries also have to work together to think what is a resilient structure. I mean, one example I can give that is really promising is you have heard of the ASEAN power grid, right? So the countries are thinking what is the right way to collaborate with each other in terms of natural endowments? For example, Laos, Cambodia, these countries are very well endowed in terms of natural, green power resources. But of course, they don't necessarily have the resources. And other countries have the resources. So they have to work together to think how to create a mutually beneficial type of arrangements for green-related investments to take place, but that also enhance the infrastructure that would make investment attractive in these economies.
But Dong, when we talk about investment, whether it is green investment or tech investment, clearly the largest pool of capital and dynamism in those areas right now happens to be China. And we've seen over the last 2 decades, as China has sort of moved up the value chain in manufacturing, moved up as an economy, Chinese companies have been investing overseas. And we see that investment in many parts of the region, and in Southeast Asia, but also elsewhere in the world. So despite the trade war, or in spite of the trade war, do you see the big capital surplus economies of the region, China number one, but also Japan, Korea, them remaining critical investors in Southeast Asia?
Absolutely. In terms of, just to give you a number to start from, in terms of the stock of FDI in ASEAN, it's about 2 trillion US dollars. But the majority of that were a legacy of the past, in the sense that the largest sources came from the US and Europe. And China, despite having grown quite fast, FDI from China since pandemic, I think, has been growing very fast. But in terms of the stock, it's still less than 10%. It's only 9%, as compared to more than 40% coming from the US and Europe. So the picture is changing. I think the Northeast Asian economies, Japan, Korea, and China, they are climbing the innovation ladder very, very fast, and they are already world leaders in some industries. So that would be a very good source of know-how, and their FDI will be very welcome in this part of the world. So that is really a bright spot there.
Right. So, Dong, you began this conversation by saying that despite what the models would say in terms of negative impacts, so far so good, maybe thanks to the AI cycle, but generally speaking, the first half of this year has been okay. On the trade side, there's this whole story that there's been a lot of front-loading of trade with the U.S. And then in the fourth quarter, we will get some really bad data out of Asia because exports will more or less, decline sharply because of the front-loading. What is your sense of this issue?
Well, there are signs of slowing down already, right? So that's expected. I think front-loading was certainly part of the story. So we do see a slower momentum going forward. But I think even there, one has to think empirically what's happening at the moment. So what I think understand some emerging evidence shows that there is quite a bit of burden sharing going on. Exporters are taking a hit; they are reducing their margins. But some of the big retailers in the U.S. also are reducing their margins, and consumers in the U.S. are taking a little bit of a hit, but not too much. So going forward, whether this picture will continue to be the case, I think there are worries that maybe the retailers have reached the end of their ability to absorb some of this rising cost. But remember, the U.S. is a very large economy, and the imports are only a small part of the GDP. So I think tariff alone would not necessarily derail the U.S. economy itself. I think the U.S. economy may be slowing down, but the policymakers, the Fed is a very skilled central bank. So hopefully they will steer the economy. And broadly speaking, that's very important for the global economy.
Absolutely. So, Dong, the way I think about the U.S. is that while tariff-related issues are a concern, they are a concern. Immigration-related issues could also lead to some inflation problems, some of the other things that the authorities are doing, including their fiscal policy. They will constitute a multitude of sources of concern, not just the tariff issue alone. But coming back to the burden sharing, I'm really fascinated by this. So let me paraphrase what you just said. So there is 3 layers of burden sharing. I, as an exporter, might take some margin compression. You, as an importer, might take some hit on your balance sheet. And then the remainder goes to the pockets of the American consumer. Looking at import data, price data out of the U.S., and there's quite a bit of data product-wise, country-wise, we can see that evidence of all 3 are already there. Walmarts of the world have given warnings about their balance sheet getting hit by the thing, but at the same time, we're seeing import price of a lot of these things that are tariff hit are going up. Did you see this coming when the tariffs were announced, or this has been a bit of a surprise for you, this 3-pronged burden sharing? Or you would have thought that American demand is fairly inelastic and prices will just go to the U.S. consumers? Well,
I mean, there were some studies showing the last round of trade tensions between the U.S. and China, so that seemed to be the case. But this round, I think there is, some interesting development. But in theory, actually, as I mentioned earlier, the impact on the imposing country is not that obvious. One channel is, given the dominance of the U.S. market, they could sometimes even manage to extract some terms of trade gains out of this, in the sense that actually one sign is that we have seen some producer prices declining in the region. So I'm just wondering whether it's one sign that even some of the prices actually have been declining in this region in order to maintain some of the export competitiveness.
What does trade theory say about retaliation? If I impose tariff on you, should you impose tariff on me?
Well, from a welfare point of view, probably no. I think what we have been worried is that if there are rounds of retaliations, that could lead to really a very bad outcome for the global economy. I think that was, the lessons from the 1930s, as you would remember from books, not from your own experience, right? So that was the bad outcome we were, economists tended to fear. This round, I think the big countries, certainly I think China, the US, they have been managing this round of tensions quite skillfully, I would say. Of course, China is facing very large tariff increases, but they have been negotiating. I think there have been several extensions of the pause, and hope a longer-lasting agreement will be reached that would not lead to further escalation of tensions. I think that's something. I think the major risk we see in the outlook in this region is still escalation of the tensions. That cannot be ruled out, as we were recently made aware because
in
of
the last
higher,
few days. Yes.
That's right, in terms of pharmaceuticals. Right. So that has been a risk we have been flagging on semiconductors as well. I mean, that would be even worse, right? Because this region is really reliant on semiconductors. So those risks cannot be really ruled out. Right.
Dong, earlier when you were talking about company-specific strategy to deal with the uncertainty around trade war, you said that you should set up supply chains, you should make your production processes more resilient. Aren't these things costly, and would that not lead to lower margins or higher inflation?
Well, when make investment decisions, you always have to be forward-looking. I think you have to prepare for 5 years, 10 years down the road, and for a more fragmented world. And these are not easy decisions to make, certainly. But you have, businesses thrive if they have a forward-looking view.
But a fragmented world is less profitable and or more inflationary?
I think that's the worry. I think a fragmented world would probably lead to less efficiency. As we know, in the ideal world, maybe I think the height of the globalization actually show that, when we scale up, when we use the global markets as our home base, I think that of course is the most efficient outcome in terms of cost. But of course, the downside is that there could be some fragility in that network, in the sense that if we are talking about sovereign countries, if there are non-economic factors came into being, and that might disrupt this kind of production processes, and that could cause disruptions. So now I think the thinking is that how to build some resilience while still maintaining efficiency. That may, the world may not be one single market anymore. Right. But I think these are some of the considerations.
Sitting here in Singapore, running the AMRO office, do you take a view on global growth, or are you just focusing on Asian growth when you make your forecasts?
We don't do a separate forecast of the global economy. We primarily rely on the global institutions and for them to have a view on the major economies. But we take those as given as our assumptions when we do our own forecast.
And in terms of ASEAN plus 3 economies forecast for 2026, I think 25 is over, so we leave 25 behind. It's been slightly better than expected, and that's all understood. For 2026, what's your growth forecast overall theme?
We are launching an update to the ASEAN plus 3 economic outlook on October 9th. Stay tuned.
Very good. But generally speaking, the point that we made earlier that there is a likely slowdown in trade momentum, having put the front loading behind us, is that a issue that you will sort of build into your forecast for 2026 as well?
Absolutely. I think that's an important consideration. Yeah.
Now, ASEAN plus 3 countries are by and large price taker as far as energy is concerned, as far as commodities are concerned. Okay, Indonesia, Malaysia are exporters, but net basis, the region is very much beholden to oil and gas and coal prices and so on. Is that something that we need to worry about going forward? In the past, commodity forecasts were pretty important, but it seems like we don't worry about that these days, despite all these, Middle East tensions and Ukraine-Russia issues, that commodity prices are fairly stable. So I just wanted to ask you, by the by, looking at 26, on various risks to the outlook, do you think of commodity as one of those risks?
Yes, we list that as the third important risk in our sort of risk scenarios. I think the first one is escalation of trade tensions. Second one is more volatile global financial conditions. And the third one is a potential shoot up of the energy prices. Some of the economies are quite dependent, as you are very aware, in this region are quite dependent. I'm not an expert on the commodity prices, so I don't do an independent forecast. But as you mentioned, that energy prices have not been volatile as feared, but we cannot still rule out. Some of the geopolitical tensions are still there. The outcomes are quite uncertain. So what's going to happen? We cannot. I think our advice to the policymakers is that this is something that still need to be prepared. That's why the policymakers have been quite cautious when they sort of half of the central banks have lowered their rates since early April to support the economies, but they have been doing this rather cautiously, and they want to preserve policy space precisely because of these shocks could be still hitting them.
Okay, perfect segue, because that was exactly the question that I was going to lead into. Let's talk about policy space in the region, but let's start with fiscal policy. We'll go to monetary momentarily. With the sort of backdrop that we have around uncertainty and fragmentation, is there a clear-cut fiscal policy recommendation?
So fiscal space in the region, I think, is moderate. Broadly speaking, I think there's moderate amount of fiscal space. In certain economies, it's larger than others. Some of the countries, but Asia, I think Asian economies are broadly fiscally quite conservative. Most of them. I think there is still some space to be used. I think fiscal policy is less limbo than monetary policy. So from a cyclical point of view, you have to think what is the most efficient way of doing counter-cyclical fiscal policy. Our recommendation is that for some targeted support that can be quite effective. But more broadly speaking, I think countries have been quite, our advice is for them to be cautious.
In the US, especially in the agriculture sector, I'm reading stories that because China, as part of its retaliation, is not buying soybean from the US soybean farmers are under stress, and the Trump administration is saying they'll take some of the tariff revenue, assuming it's fungible, and put it as a subsidy for the agriculture sector. I believe they did the similar thing in the Trump 1.0 as well. Is that best practice? Would you recommend things like that? If we reverse the story to Asia, that exporters are under stress, should the governments give them subsidy?
Well, I think the first consideration is that you don't want to create the distortions for the longer term.
Correct.
Right? Some of these targeted support can be useful. I think the COVID period was a good example because that was such a big shock. So fiscal policy played a very important role of supporting households to smooth over the period. Macroeconomic policy really has the important role of coordinating expectations, because when the economies are hit by a very large shock, people became very cautious. So at this time, you want to provide a bit of support to coordinate actions so the economy does not really go into a bad equilibrium. So that's really the role of macroeconomic stabilization. You want to create some of this coordination mechanism. fiscal policy, I think, played a very important role. Some of this household direct support that I think cushioned a lot of the economies. But you don't want to create, subsidies that lead to distortions that would permanently distort decisions by firms which sectors to invest. I think that's usually quite risky.
Let's come to the monetary policy side. So as you pointed out, several central banks in the region have cut interest rates. Inflation doesn't seem to be a concern right now, whether it is commodity or non-commodity related inflation. Is there more room to accommodate monetary policy in the region?
Again, I think there is a moderate amount of room. In this region, as you know well, central banks have to consider various things. Many central banks are already inflation targeters. So of course they look at their domestic prices, but those domestic prices can be influenced by global factors. Another consideration is global financial conditions. There's traditionally quite a strong influence from global financial conditions, particularly led by U.S. monetary policy cycles. When the Fed tightened its policy stance, dollar tended to be strong, tend to appreciate. That usually tighten financial conditions. And in that sort of condition, it's harder for the central banks to loosen, to work against that sort of tightening. And because they have to think what the impact on the exchange rate. They sometimes worry about too much volatility on the downside for the exchange rate. And this time around, what's interesting, as you know well, is that the dollar has depreciated since the early of the year. And to some extent, that has provided some space for the central banks to loosen their monetary policy stance.
Dong, you talked about the risk from the downside to exchange rates. If countries cut rates too much or prematurely, the currency can under pressure. Let me ask you about the other end of the risk. If currencies do appreciate substantially in the region, what are the risks around that?
Appreciation. Traditionally, it's more about, if it lead to real appreciation of the exchange rate, that could have some competitiveness pressures. Right. But on the financial side, I think it depends on the balance sheet structure. And if you have a short position, particularly, a lot of the banks use dollars, it's a major funding currency in the region, then that could be a problem. Right.
I want to talk about financial sector stability in a second, but just want to stay with that argument for a moment. If I'm facing a terms of trade shock because of tariff, plus I'm seeing my exchange rate appreciate, it's a double whammy.
It could be, yes.
And I think that's what's vexing many regional policymakers, because in Trump 1.0, when we saw the tariffs, it had the opposite impact. Dollar appreciated, and in response to tariff, countries saw their exchanges weaken. This time, it's going the opposite direction, which may get them out of trouble as far as the U.S. Treasury is concerned, allegations of currency manipulation, all that stuff. But as far as their exporters are concerned, really is a two-pronged challenge.
But the exchange rates have largely, as you mentioned, there is some appreciation, but it's not a very strong one, right? It's moderately. So I think this is a reasonably comfortable situation.
Good. All right. Financial stability. As I said at the introduction of this podcast, that's how I remember you, Dong, as a financial sector expert going back years. What's your sense of financial stability in the region?
As I mentioned, traditionally, global financial conditions influence this region a lot. So policymakers tend to look at global financial conditions a lot. I think domestically, this round, when the tariff shock came, of course, markets reacted. But since then, I think most financial markets have been quite resilient, quite stable, and in terms of equities, the +3 economies have been doing somewhat better.
Yes.
Than the ASEAN markets. I think that's very much tech related, and on the bond market side, I think the yield curves have typically declined. So it has bond markets have been doing pretty well, quite stable. But in terms of banking sector, I think we see a lot of resilience in the banks in ASEAN Plus 3 economies. So that this is very different from, as you remember, when we worked together in those years, there was in the early 2000s, coming out of the Asian financial crisis, there was more, those days there were more worries on the banking system. I think these days, the banks really have been strengthened.
Absolutely. So I think one of the legacies of the 97 financial crisis, 97-98 crisis, was the improvement in bank balance sheets, supervision, transparency of reporting. And I think that's a good legacy to have had. We've seen similar things happen in the US after the GFC. 2008, 2009 led to all sorts of measures to make the US banking system narrower, more resilient. But one fear in the US is that some of the risks may have jumped from banks to non-banks balance sheet. Are there similar concerns in Asia?
Less than in the US. I think the non-bank financial intermediation worries, I think, were centered on US and have been centered on US and Europe. But that's something in Asia. I think policymakers have also taken an interest in the subject, but I don't think it has become as prominent as in other places. Issues with private credit, it's on the horizon, but it's not as large as in other parts of the world, in the advanced economies.
Right.
In China, of course, a few years back, it's those non-bank financial intermediation related to wealth management products, and those issues have, I think, in a way, have been under control.
Yes, indeed. We saw in 2008, 2009 that a shock that was localized in the US very rapidly became a global shock, from the subprime crisis to hitting the spreads all over the world. Now, one thing that I worried on is that when I travel in Asia, whether it is in Singapore or in Korea or Japan, high net worth individuals own largely US stocks. Sovereign wealth funds own a lot of US treasuries. And corporations, through trade or through finance, have huge amount of US dollar exposure. So in a situation where the dollar depreciates and or there is some correction in the US market given its lofty valuations, that interdependence, that risk, how big is it for Asia?
I don't know exactly how big that is, but it's an important risk. As I agree with you, but what's interesting is that the U.S. markets, particularly equity, has been doing really well, right? And that's a reflection that the equity markets are really a global market. It's not the U.S. necessarily the U.S. firms. These firms are really global firms, yes. And they have production networks in different parts of the world. So Asian investors like exposure to equity markets in the U.S., but they probably are a little worried about the dollar. And one research done by the BIS shows that part of the reason for the dollar weakness is that global investors, including investors from Asia, are hedging their dollar exposure. While they still like the U.S. assets, they are probably hedging some of the exposures to the dollar.
Right. So I look at the IIF's monthly portfolio tracker database to get a sense of exactly what you're talking about. It seems to me that there's certainly been a big pickup in fixed income flows to the region. And in the last few months, equity flows have started to pick up, particularly with respect to China. So, Dong, so far we've generally talked about the region, but let's talk about China a little bit, because it's such a large economy and its impact on the region is substantial. So whether it is the property sector issue, or resiliency around trade war, or the tech-related developments that we're seeing in China, just give us a sense of your assessment of the Chinese economy.
So I think external side actually has been a bright spot for the Chinese economy. The economy in broad terms has been quite steady, but we do see a sort of like a two-speed economy, a little bit of that, in the sense that the newer sectors associated with the new technologies, these have seen robust investments and activities have been, strong. Whereas in the legacy sectors, like the property, that have taken some time. I think, in a way, they are still in the process of working out some of these legacy issues. As you know, the property sector and the related construction activities were a very important driving force of the Chinese economy since the 2000s. And they have taken a big hit since the pandemic. It's about 3-4 years now, I think. And I think they are, in a way, still in the process of working that out. And to some extent, I think it's a loss recognition and allocation process that has to be completed. But there's some optimism that we are seeing the end of the beginning of the end, at least. The higher tier cities, first tier, second tier, I think these markets have really stabilized, and the lower tier cities, I think it would take a little longer for the stock the overhang of the stock to be worked out. So I think in terms of the financial stability, the big banks are in very strong position, right? Some of the lower tier, smaller banks, they could have a little more exposure to some of these property-related sectors or local government financing vehicles. Some of these, I think, I think they have been actively dealing with this some of the problems, smaller banks, and again, we could expect that process to be completed in a few years' time.
So, Dong, the question that I'm about to ask you, I think most people will not be able to answer this question authoritatively, but you have spent such a long time dealing with financial sector issues, looking at cross-country evidence. You are the right person to ask this question. The property deleveraging cycle in Japan, US, China, are they more or less the same, or are they built and are they evolving differently?
I think the property sector is really one of these interesting sectors that, there are a lot of local peculiarities you have to deal with. So I think that's a very hard question to answer. There are, I think there are commonalities. So broadly speaking, I think one can learn, these economies can learn from each other in terms of the macroeconomic impact of property sector. So that's one commonality I think we can observe. Property sectors do have a very important macroeconomic consequences. So that's one commonality I would share. But again, we know that these are very localized markets, and specifically, what does it take for each market to recover? I think that's a very, very country-specific or even municipality-specific question.
Well, absolutely. So, Don, one thing I remember, because I worked on the Japan desk back in the days in the IMF, that Japanese banks were characterized by cross-shareholding and equity of their counterparties, and that got in the way of their willingness to restructure. My understanding, and I've asked many from your ex-MCM department, the IMF, the same question, the view is that the Chinese banks are not subject to that sort of constraints of the cross-shareholding. But I want to talk about the U.S. experience with the property sector bust from 2008 onward. We had a decade of deleveraging, both by U.S. households and corporations after the GFC. But during that time, there was a huge positive wealth effect taking place in the U.S. Because of QE, bond prices were rising, corporate debt spreads were narrowing, and of course, the equity markets went through a massive pickup. Is there a lesson from that you should pursue very aggressive, easy monetary policy when you face a big shock like a housing crisis?
So the U.S., I think also, I mean, we before I answer your question, I think we should note that households in China are not nearly as indebted, right? So because many of the mortgages, they were not as large. In general, I think the Chinese households save a lot to buy a property. So I think on that one is very different from the U.S. But more broadly, the role of monetary policy, I do believe it has a very important role in cushioning the downside. So people tend to think that if there's inflation, monetary policy can be tightened to deal with that. Actually, from a financial stability point of view, using monetary policy in downturns to protect financial stability, I think that's a very important role. That's usually underappreciated because we know there's a lot of leverage if in the financial system. If there is a major downturn in asset markets, then collateral constraints become binding. And then that could be a downward spiral. So that kind of bad equilibrium is precisely what monetary policy can help prevent. So I do believe that's a very important role to play.
Dong, you are taking me back to my university days. Way back in 1998, when I was a summer intern at the IMF, Ilan Goldfein and I wrote a paper arguing exactly that point, that the role of monetary policy in stabilizing financial system must be cognizant of the corporate balance sheet situation. If the balance sheet is fragile, you have to be far more careful than dealing with defending the currency by hiking rates, because that could be counterproductive. See, Dong, we were ahead of our time. Now, property market is, of course, a very big consideration when we think about financial stability because of the nexus between banks and the property sector. Dong, the other thing where in my bank and elsewhere in the region, we have also started thinking about is the intersection of financial market risk and climate risks. Is AMRO in its research looking at this issue when its surveillance work?
Yes, indeed. Climate risks are one of the structural issues that our membership has asked AMRO to pay attention to, because these, as you know, climate risks are a very, very important existential risk.
Absolutely.
I mean, of course, for financial stability, both physical risks and transition risks are very important. So the bank, of course, in the region, policymakers, regulators are taking a whole of system approach to climate risks. I think broadly in terms of the macroeconomics, as you would probably appreciate, when we think about climate risks, what is the issue? The issue is that carbon emission has a lot of externality. In this sort of situation, because one individual emitter doesn't take into account the consequences of its action for the world, for the planet. So what is the best way to deal with this? In economics, the best way to deal with such externalities is to impose a Pigovian tax, and that's the most efficient. So carbon pricing is actually the most efficient way to deal with this. But so as we know, carbon pricing has not really made a lot of progress in the world and in the region. In the region, actually, we are lagging behind Europe in terms of either imposing a carbon tax or emission trading system, a cap on the emissions. So the region, Asia, I think, is lagging behind Europe. But in this kind of second best world, financial policies are also very, very important in playing its role in managing climate risks.
It's interesting, Dong, I fully agree with you that Asia certainly lags Europe in progress toward market-based pricing of carbon emission. But I take some comfort in the developments in China, where they've done many trials and errors, and they've learned from the errors, and they're making the carbon trading market a little more functional. But Dong, the thing that I really take biggest amount of comfort is the kind of breakthroughs in climate tech we're seeing coming out of China.
Absolutely.
And how that can certainly find solutions for many of the problems we have in Southeast Asia.
Absolutely. I think China is a leader in green technology, and that's a major contribution the country can make to the world.
Now, at the very beginning of this conversation, when you were talking about the impact of the trade-related uncertainty, you pointed out that one useful offset was the AI-related spending and the investment. Let's end this conversation on that note, which is, what's your sense of the big AI wave for the region?
So, as I mentioned, semiconductor-related investments and AI-related investments have been growing very fast. And a bright spot is that some of these, if the FDI data centers and all that related FDI materializes, that could underpin private investment in the medium term for the region. But of course, when we are in the middle of such a boom, policymakers always have to worry whether there is some amount of froth in it. So we have to be aware of potential risks. If there is a change in the sentiment towards AI, remember the internet boom, and in the end, that episode, the lesson was that if there is not a huge amount of leverage, the financial systems and financial markets can probably survive. So we have to be aware in this kind of boom whether leverage is being built up, and we want to be careful there as well. You never know. I think these sort of technological breakthroughs in the longer term are very important for the welfare of the humanity of the global economy. But from a cyclical point of view, there could be over-optimism, there could be exuberance, and policy instruments are there to prevent some of the excesses to lead to bad outcomes.
Okay, the underlying technology is promising, consequential, fully agree. Froth, perhaps. But what if some of that froth leads to a boom-bust cycle? Is there a risk like a 2008 type situation, because the whole world has decided to put so much money on this technology? And if there's some froth in valuations, could that lead to a very painful adjustment?
So, absolutely. That's the point I was trying to convey. That is, in this sort of boom time, regulators and policy authorities should be on guard. Don't be, while acknowledging the potential of these technologies, don't be complacent. It's when there's a boom, risks are being built up. I think that's a very important lesson. Actually, when you think about the risks, it's when there is boom. And if it's a downturn, it's a realization of the risks. Risks are not necessarily being built up.
Spoken like a seasoned financial sector expert. Dong, such an interesting conversation. Thank you so much for your time and insights.
Thank you for having me. I enjoyed
It was
it.
great to have you, Dong. Thanks to our listeners as well. Kopi Time was produced by Ken Delrich. Violet Lee and Daisy Sharma provided additional assistance. All 162 episodes of the podcast are available on YouTube and on all major podcast platforms, including Apple, Google, and Spotify. This was for information only, did not constitute any investment advice. With respect to DBS research and publication, you can find them all by Googling DBS Research Library. Have a great day.